Da da da, live, we're live. Ah, Thanksgiving can't come soon enough. Seriously. What is going on? Everything's loading. Waiting for all the fans to join. Let's see, what did I miss at the end of the market close? Let's see. Yahoo. What is going on? News. Da da. Why Google's AI wins are bad news for Nvidia stock and the AI trade. Okay. That's interesting. Chat. Hey. So, only have a few days left. Yeah, crazy, right? Meta using Google's TPUs. Wild. It's nuts. I'm taking a deeper dive on Meta literally as we speak. Crazy stuff. Yeah, Meta's a weird one because everybody's like slagging them for increasing their capex, and it's like, what do you expect them to do? It's AI bonanza, and it's like go hard or go home. What do you expect them to do? Not spend tens of billions of capex? It's pretty crazy though, because historically Meta has had like 25% capex as a percentage of revenues, and moving forward it's going to be like 45-50%. So it's pretty remarkable how much capex they're going to be really doing. But it's nuts, the growth that is resulting. Kind of wild. I saw an article which was kind of weird. It was talking about how AI companies are tapping the debt markets, and that could be some sort of an issue. I was like so like confused by that when I saw it, because it makes no logical sense. They're loaded with cash. They have massive amounts of free cash flow. So it's like, what are you talking about? And they said even after all of these rounds of debt that have been raised, the debt to EBITDA is still less than one. It was just like, I hate these like nothing burger stories where they, make it like seem like some big crazy thing is happening. And then you actually read the article and it's like nothing. Yeah, it's just nuts. Yeah, and then private credit. I saw a thing. It was Jeff Gunlock, the bond savant, said we're going to have a crisis in the private credit markets. They're private. Like, what kind of crisis can we have? It's just like bananas. But then you have Howard Marks, who runs Oaktree, who's a multi-billionaire, and he's like, yeah, I don't see any issues with private credit markets. And you're like, okay. It's just crazy how you could have people just so diametric, and they're in the same space. They're all super qualified, know a ton of stuff about this. I'm always fascinated by that. One person says the market's overvalued, and then another person comes in and it's like, it's not even close to being overvalued. And you're like, what? And then, December rate cut hopes go, up, and then the market just like rips. Like they're gonna cut the rate like 25 basis points. Has like very little impact on in the grand scheme of things. It's just like bonkers. I don't get that. But now everybody's probably a lot more chill than they were last week. Everybody's like flipping out last week. My portfolio's down 30%. What am I gonna do? And now this week it's like, yep, everything's cool. We're all good. I didn't even see where Meta closed. It was like 6:15 when I was watching it earlier today. But it was on fire. Everything was on fire. Damn, the NASDAQ up 2.7%. Ba-boom. Meta 613. Okay. I saw it going up to 615. But that one makes very little sense why it got absolutely housed. But we're taking a deeper dive. I mean, it was undervalued when we looked at it last time, which was like a month and a half ago. It's still going to be the case. And the big difference was they like increased their capex by like a few $1 billion. I don't see how that's like the end of the world. But sometimes this stuff happens. People just like crazy overreactions. There's also a lot of profit taking that happens, reallocation. There's a whole bunch of different pieces that go into it, but that that is the story. But I don't know. I don't think the market's like too crazy. I think obviously AI is everything right now in terms of the theme, but I think there's a lot of other opportunities outside of AI. We've talked about Constellation Brands, Lululemon. It's just funny to me when people will be like, people are drinking less, like with Constellation Brands. And it's like, okay, like, are people not drinking? No. All right, so then that's not going to be an issue. I was at the bar yesterday watching football. Everybody there was drinking. So a bunch of people were drinking Modelo, I saw. So it's just wild. Like, we just extrapolate things to the nth degree. I don't ever understand that. But therein lies the challenge, friends. Overcoming the crazy sentiment that occurs. Excited for Thanksgiving. I'm definitely excited for Thanksgiving. I'm more so excited for like the chill part of Thanksgiving than like the actual holiday itself. I'm just like looking forward to decompressing for a little bit. And then yesterday you got I'm a Giants fan, and you know that they're going to lose, but you just don't know how they're going to lose. And it's funny, I texted my buddies, they're up like 10, and I'm like, how are the Giants going to find a way to lose this one? It's like, surprise. But at this point, they're mathematically eliminated from the playoffs. I don't even want them to win. I want them to lose all the rest of the games, get a good draft pick. There's no point in winning at this point. You don't even have a coach. It's nuts. Wild stuff. Wild stuff. I think my fantasy hopes are dashed. No good. Won 4 in a row, and then this week, Josh Allen just totally didn't come through. I mean, the previous week, he went bonkers, but totally didn't come through. And then same game, Dalton Schultz, total letdown, 1 catch. Duh. So, but our opponent, he's smoking it. So he's going to have like 150 points this week. We didn't even break 100. Just getting trounced. Absolutely crushed. Let's see what else is going on in the news here. GDP, retail sales, and other can't miss items this week. Wow. Alphabet stock is a Berkshire win. The gain so far may be 40%. Not bad. We called it first, by the way. What are some other interesting ones here? Chipotle down again. Womp womp. Warren Buffett warns not to listen to investing gurus. That's an interesting one. Let's see. You always got to be careful. This is from barchart.com. Let's see this. I'm always fascinated by things like this. What are they saying here? What's going on here? Warren Buffett warns not to listen to investing gurus. Okay. The only value of stock forecasters is to make fortune tellers look good. That's a good one. Let's see. Built a reputation. We've long felt the only value of stock forecasters is to make fortune tellers look good, he wrote in a 1992 letter, summarizing his long-standing skepticism towards predictions about short-term movements in stocks or the broader economy. Totally agree. Statement appears in one of Buffett's widely read annual letters to Berkshire Hathaway shareholders, where he has often urged caution against relying on expert forecasts. Okay. I feel like this is turning into one of these, another nothing burger article here. Buffett's dismissive stance towards predictions is informed by decades of observing how individual. Okay, what's the point we're trying to make here? They're just talking about an old Buffett letter. Although the comment, here we go. Although the comment was made years ago, its relevance remains consistent across market environments. Yes, in times of optimism, forecasting tends to flourish as analysts attempt to justify rising valuations. In periods of volatility or economic stress, forecasts become even more extreme as prognosticators respond to investor anxiety. Buffett's statement highlights the timeless reality that forecasts rarely offer investors an advantage. Rather, disciplined decision-making and a focus on intrinsic value. Hey, intrinsic value. That's what I'm talking about. Buffett's observation serves as a reminder that the most reliable guide for long-term investing remains the performance of real businesses, not the accuracy of forecasts meant to anticipate the next market move. Well, yeah. Again, this is like, what was the point of that article? I don't get that. Here we go again. I just got put into the corner. So there's like a setting here, show layouts. There we go. I don't know why it put me in the corner like that. Bizarre. Yeah, clickbait. I don't get it. It's like it sounded really good, and then it just like there was like no real conclusion there. Celsius didn't get any love today. Yeah, I know. I think this was the reversion of the whole AI dump that had occurred last week. It's like there's an AI bubble. Everybody sell, and now it's like there's not an AI bubble. Rates might get cut 25 basis points, so let's go reflate this. Yeah, I noticed that. There were a few other ones I was looking at that weren't getting love. Basically all the non-tech stuff. So Lulu didn't get the love. Who else? STZ. I don't know. Lulu got a little bit of love. Let's see. Oh, and it's up even more after hours. Closed at 169.67. We might get above 170, fellas. Hey. Oh, it actually did. It traded above 170 today. Wow. So the day, it was up to 172 today. That's interesting. Lulu back on track. STZ, not so much. Not so much. So it's down for the day, but it's up after hours. Okay. Very interesting. Uh-oh. Oh, this is 6 weeks ago. I was looking at an article from 6 weeks ago. I'm like, this is new? No, it's not. It's from 6 weeks ago. Hi, Ken. Just curious to know if you were tempted to dabble in SoundHound yourself after this last video. So SoundHound is the type of company that you trade. It's not at the point right now where I'd be willing to like buy and hold it. It's kind of one of these stocks like you buy in the current scenario, like you buy below 12 and then you sell when it hits 18 and then like it just keeps doing that. It's one of the few stocks that I've come across that like it's not just going to take off. So a counter example would be like SoFi. So like SoFi was like that for a little bit, but then kind of like hit this like glide path. But ultimately, yeah, Palantir is another one that, just hit this glide path and then it's just like escape velocity. SoundHound's one of those ones where, it's not going to go below like it's like high single digits. That would be interesting. I don't see that happening. But, it hits these like crazy valuations. It's like 24 something. And then it's like, this is definitely coming back down to earth. And then it comes back down to earth. So, I mean, there's definite value there. I just don't have like the time, frankly, to like watch it enough to take advantage of that kind of like up down volatility. But that's kind of one of those stocks where it like hits a ceiling, you sell it, it comes back down, you buy it, and you just keep doing that. I would just miss like those points because people end up like sending me comments on the channel and stuff, and they're like, SoundHound's $20. Do you think it's overvalued? It's like, yeah, it is. But I still think it's going to get bought out by somebody. I mentioned in the video, the thing that I really don't like about SoundHound is the amount of shareholder dilution. So management does not get compensated via a salary. They're getting fully compensated with shares. The problem with that, so when I did on my school community, I do a deep dive that's like way, way deeper than, the 15-minute video that we do on YouTube. And one of the things that I mentioned was their shares have increased 6.1x since the IPO. 6.1. I mean, it only IPO'd in 2021. So the stock would be 6 times higher. It'd be like $72.64 if they didn't issue more shares like they are. And that's really the big qualm that I have with SoundHound. I'm not like anti-SoundHound, but it's just one of these stocks that you have to kind of like sell when it hits the peak and then buy back when it goes down the trough. But you really have to be on top of it because like that's a stock that can change crazily enough. When I was going backwards, like 50% in a month. That's the crazy thing. 50% in a month. So if you go backwards, this was December. So December of 2024, 2 weeks after it hit the high. This is like, I'm like looking at it real time. So December 30th, 2024 was at 2268. Okay. And then hold on, January 13th, 2025. Okay. 2 weeks later, $12.82. So it lost $10 of value in 2 weeks. 2 weeks. Like, that's just crazy. So you get busy, you're living life and everything, and you're like, oh my gosh, what the heck happened here? I mean, I have Joby, and Joby seems like a sleepy stock compared to SoundHound, which is bananas to think. It's nuts. So I'm not like anti SoundHound. It's just when management starts getting paid in like cash and not shares, I'd be way more inclined to buy the stock. That's just the big thing that's like killing me. I mean, you just keep diluting the shareholders. It's like, oh my gosh. Now, the one counterpoint to that is as the stock increases in value, you're going to have to give less shares for the same amount of value, right? So if I'm paying you $100,000, but I'm doing it via stock, I obviously have to give you a lot more shares when the stock's at $4 versus when it's at $24. So there's less dilution net as the price goes up, but the point is still the same. And that's, I think, where the challenge is with that. And then I see right here, yeah, PayPal. That is true. PayPal's a bizarre one. That one, I can't make heads or tails of it. Now, ironically, we saw the Warren Buffett article earlier. Um, over time, the value will shine through, but that one's just like painful. I mean, they crushed the results. It's so funny because you hear people and they're like, oh, well, if PayPal, if they pay a dividend, that's when the stock will rip. They pay a dividend and like it went up that one day and then just back down to earth. Nuts. Oh, here's an interesting one. Crypto. Do you have an opinion on Ethereum versus Bitcoin versus Solana for a 3-year swing trade? Crypto is positively correlated with tech and AI. I feel safer with blue chip tech, smart, and crypto rather than smaller AI. Yeah, you're 100% accurate there. I'm a fan of all three, namely Bitcoin, Ethereum, and Solana. I have each. I think, this is one of those things where you have this big pullback. That's kind of the time to lean in. When you look at, it's funny on like the Reddit forums, like the R Bitcoin, and you've got people that are like trading it, and I always love it. Like they'll show like, oh, it's the bottom. No, it's the bottom, and it's the bottom, and then like they all end with people applying to work for McDonald's, which I always think is funny. The whole thing is the swing trade. The next trade with crypto would be the halving, and I think the next Bitcoin halving's in 2027 or 2028 from when I last checked. Let's see. Next Bitcoin halving. Mid 2028. Yeah, so the halvings are obviously less frequent now. But that's really where I would look at it. I mean, look, you say so yeah, 3-year swing trade. Yeah. So it'd be until the next Bitcoin halving. I definitely think it's going to be on an increasing path for sure. In terms of one versus the other, Bitcoin, Ethereum, or Solana, I don't really have like a hardcore opinion one way or another. With one of those three, I would say those are the three. Just like you mentioned, smaller AI, like don't waste your time with that. I don't even like bother looking at altcoins and stuff like that. That's like rat poison trying to mess with that. But I mean, I think it is definitely a good opportunity to lean into Bitcoin right now, specifically. But yeah, they've all pulled back. But again, this is one of these things where I find out about it when people are like, oh my gosh, did you see this? And I'm like, oh, yep, there it goes. But that's a long-term play. Whenever it comes to crypto, I'm of the hodler mindset. So, you buy more when this happens, but you accumulate over the long term and hold. But I'm always leery of trades unless there's like some sort of dislocation or there's some sort of catalyst. Those are the times I like trades. So, for example, um, when Buffett ended up getting into Activision Blizzard. And that one was a no-brainer because it was being bought out for all cash at 95, and he was able to accumulate a huge position at 75. That's the type of trade I like. I like those types of trades. But outside of that, there's no real catalyst per se. With crypto, I wouldn't look at it as a trade. I'd look at it as an opportunity to accumulate. What's your price target for BTC? How do you value it? Yeah, it is definitely in the too hard pile. Um, I mean, people just do it based on supply demand. I personally don't have, a particular target for year end. I'm kind of looking at it more so for the long term. Damn, 87,982. Wow. Last I checked, it was like 90, like low 90s. It was funny a few weeks ago. I saw people and they're like, "Yeah, it's gonna be 160." This was like 2 months ago. Wrong. Um, I wouldn't be surprised if it's back over 100 by year end. But I mean, again, I don't trade it from a valuation perspective. You can't come up with a value for it. But I think was that Michael Saylor? He says that each coin is going to be worth. I think like in 20 years. I think he said each Bitcoin is going to be worth like $13 million. And I'm with you. Like, I don't know how they come up with the value. It's just like, okay. I mean, it's definitely going to be increasing over time. That's why I think opportunities like this, these pullbacks, that's where you can accumulate. But I don't look at it as like year end or anything like that, to be quite honest with you. Yeah. PayPal is the only company to drop after a deal with OpenAI. This is true. Hashtag facts. Bizarre. Bizarre. I mean, look, at the end of the day, it's all about cash flow. So that's something that I would kind of say in response. That's all that really matters at the end of the day, and that's what drives value. So that's what I really kind of look into and care about. But it is pretty wild. Which of the Mag 7 is a screaming buy this week? Honestly, like Meta is the one where I'm just like scratching my head, like the overreaction on the downside. If anything, it's probably increased in value since the last time we looked at it, and I think I had a value of like 874 last time I looked at it. I mean, it's at 613. That out of all of the Mag 7, that's the one that actually has the best opportunity in terms of like a discount. So yeah, I think that's the one that's the most promising at this point, like not even close. Google, Alphabet has gotten out of control because of the Buffett stake announcement. So that's not there. Amazon's, ripped, so that's not there. Tesla's obviously overvalued. We stated that when we did the video a few weeks ago. Microsoft is another good one, I would say. Um, I would say right now, Meta is probably at a bigger discount than Microsoft, but I'm fully 100% a believer that Microsoft is actually going to be the biggest winner in AI because they actually have the data centers built operational. So I still think that that's the case. And then also, everybody forgets Microsoft has a huge stake in OpenAI. So if you believe in OpenAI, then like the best way to get exposure to it is through Microsoft. Um, so that one I think is a total no brainer. All right, so hold on. Whoop. Amazon actually returned to pre-rip levels. Let's see. Well, yeah, the most recent rip when it went to like 250 something. Yeah, but that one, it's still like where Amazon was a really good play was after Liberation Day. That's where it was like a real no-brainer. It's definitely come back from that rip level. I would say if you could get it in like the low 200s, which I don't think is possible, that would be the buy on Amazon. But I still think right now Meta and Microsoft are two very good opportunities. Way better. Um, what do you think of Constellation Brands below 132? I'm still a fan. I've been buying Constellation Brands. I keep trying to maintain my position. That's one of those ones, I covered it in the video. You know, Berkshire Hathaway has a stake at 197. So you're able to buy it at a massive discount to what Berkshire Hathaway holds it at. And if Berkshire Hathaway is buying it at, they were buying it in the low 200s and the mid 200s, they obviously have to have a value of probably 300 on the stock. They have a 7.6% stake in Constellation Brands at 197. So I think they're pretty smart guys over there. That's probably a pretty good indication. But yeah, I think it's definitely worth accumulating. And then also, if you're a little, I don't want to say skeptical, but hesitant of getting more tech exposure, that's really like a counterpoint. Would be the Constellation Brands. I think Constellation Brands, Lululemon, those are the ones that I think are very interesting. Views on Michael Burry and his ideas about depreciation and extending lives of their assets. So I didn't see that one in particular. I know that he shut down SoUN, but he actually did. He bought 100,000 shares of Lululemon before he shut down. So I do know that. But I'll go look at this in real time to see what it is that we're referring to here. So Michael Burry, depreciation, useful lives. Oh, Michael Burry calls fraud in big tech. Dun dun dun. I guess is this his point? All right, so we're using I guess it's this is, I guess Gemini would be this AI overview here. Burry's central thesis, he claims that hyperscalers are using overly optimistic accounting estimates that do not reflect the rapid pace of technological obsolescence in the AI industry. Key points of his argument include inflated earnings. By extending the useful life of assets from 3 years to 6 years, companies spread the depreciation expense over a longer period, which lowers annual costs and boosts reported net income. Okay. He contends that AI hardware like Nvidia chips and servers have a realistic economic life of 2 to 3 years. I agree with that. Due to performance advancements, Burry estimates these companies will cumulatively understate depreciation by approximately $176 billion. Potential earnings overstatements. Yeah, again, so I don't look at earnings. I look at cash flow, so I don't think this, like you add it back. So it's not, if I were looking at net income, then maybe that would make sense. Yeah, counter arguments. Here we go. Cash flow focus. Rating agencies and capital markets often focus on cash flow and EBITDA rather than net income. Ditto. Which is affected by non-cash depreciation. Yeah, true. Some industry analysts and Nvidia's management note that older GPUs remain in high demand and fully utilized, suggesting longer economic life is justified. Yeah, I don't really buy his argument personally. Yeah, it's if you're looking at net income, perhaps, but I just don't think I don't think it makes sense. Like, because I'm not looking at net income, I'm not looking at PE ratios, I'm looking at cash flow, EBITDA. So I don't really mind what he's saying, frankly. And then also remember, and I think a lot of people are failing to recognize this, with the big beautiful bill, you could do 100% depreciation in year one. You could fully expense in year one. So I think some companies are going to do that as well. So I'm not too worried about it. Basically, what he's saying is that these assets are going to be replaced faster. Therefore, their actual useful life is shorter than what's being accounted for. It shouldn't have a big impact, frankly. Do you have any opinions on Fiserv? I think you might have raised Fiserv. Somebody raised Fiserv previously. My opinion is stay away. Um, when I was digging into it on the live a few weeks ago, there was a lot of really like sketchy, questionable stuff going on there. And whenever you have that, it's kind of like stay away. Um, they fired some people internally, saying that they didn't state numbers properly. They lowered guidance. There was a lot of weird stuff going on there. So I'm always a fan of, I'd rather not buy at the bottom, but have things get figured out in the interim. And I think it's the same thing with Fiserv right now. So I'm a fan of the company, the business model, etc. But in terms of like what's going on internally right now, it's very, very sketchy, very sketchy. So they've like fired people and said that they were giving wrong guidance to investors, and they're like not giving new guidance as a result. So like I saw all that, I was like, what is going on here? That was like super sketch, super sketch. What's your take on Uber at the current price? YouTubers can't stop making enough videos about Uber and how dirt cheap it is. Yeah, I like Uber more than Lyft as a stock, but I don't know. And I know like Bill Ackman has like this huge thesis on Uber, but I kind of look at it like this. If we look at like a Tesla and we talk about self-driving cars and all of this stuff, I guess the logic is that Uber has the advantage from an app perspective in that people like have the Uber app. So you're either going to order Uber or Lyft. But me personally, if eventually I'm going to have a self-driving car, I'm never going to use Uber or Lyft unless I'm traveling somewhere and I need a ride. So I think that's not being factored in. Like if I had a self-driving car, I like unless I was literally traveling and I wasn't near my car, I would never ever use Uber or Lyft. I would just get in my car. So I don't know what this is all going to mean. Like it'll be very interesting to see how this all plays out in terms of like drinking and driving. And I'm not being facetious, but like if you have a car on full self-driving, like what is going to be the rule with that? Like let's say someone was like they're like going to have their car drive them back from the bar. I'm just giving a pure hypothetical here. Technically you're in the driver's seat. I guess you can move to a different seat. I don't know how that's all going to play out. I'd be curious to see how that all impacts things. But also like what's going to happen? You have Waymo, right? Is Uber going to somehow compete with Waymo? That's where I'm kind of a little leery on Uber. And, you know, there's the numbers side of things. I always call it the art and the science of valuation and financial modeling. So I'm looking at the art side, not the science side. The science side's take the numbers, extrapolate them, discount it back. I got that part from that perspective. Yes, undervalued. But I think that we're missing the boat on a lot of things here where you take into account like EV toll. So like a Joby, you know, what if you have like a helicopter landing on your front lawn and it'll take you long distances, take you to like, I'm outside of New York City, so drop you off in the city somewhere. You know, now you don't have to worry about the tolls. Now you don't have to worry about traffic. I'm probably going to use that. And then the same point that I made with self-driving cars. So if you believe in self-driving cars as a thesis and you believe in these other, you know, major shifts that are happening and occurring real time right now, then you have to really question the whole Uber thesis, I would say. So that's really kind of my whole thing with Uber. But yeah, YouTubers, like, dude, don't even get me started. I always love when people are like, oh, do a video on a stock that you really like. It's like, I can't. And they're like, why? And it's like, no one's searching for it. So unless I have 100,000 subscribers, me doing a video on a stock that nobody's searching for, it's kind of like a chicken and egg thing. Unless you have like this insane following, you have to kind of do what is popular. So I literally every week before I do a video, I go on vidIQ, I see what people are searching for, and then I do the video that I know is going to get, you know, the most search juice. So that's kind of the unfortunate reality of things, at least for now. My understanding is that these companies are depreciating 100% of the capex within the first year when they aren't as valuable. 1 year later, once new chips are available. Yeah, so I think we're like a little apples and oranges here. The point that Michael Burry's trying to make is that they're saying that these new technologies have a longer useful life than they actually will because the innovation is so rapid. So to say it's like a 6-year useful life and it's really only 3 years, you're basically going to have overstated earnings because you have lower depreciation over a longer life. Where his point is you should have higher depreciation over a shorter life because the turnover is going to be much more rapid than that. But my point is, if you can just expense it rather than, spread it over time, what's that going to do? Well, that's going to knock down the earnings even more. But again, what is the return that you're getting on this? So like if a company like Meta, for example, they're, doing CapEx like 50% of revenues now, which is bananas, like 40, 50% of revenues. Historically, they were at like 20%, give or take. So now you have this massive 2.5 times increase in CapEx. Well, if a 2.5 times increase in CapEx corresponds to an increase in revenues of like 3, 4, 5 times, then yes, you just keep doing that CapEx. And that's the reality. The CapEx is going to result in future revenue. So it's like if I told you I have a magical machine and if you put $1 in, $20 comes out, like what would you do? You'd be like, I'm going to put as much money in this machine as possible. That's kind of what's going on right now with this AI arms race. The other thing too, I think people aren't factoring in is like there's a difference between CapEx and R&D. So research and development expenses have increased as well. And that actually impacts cash flows. So the depreciation, like, okay, it gets taken out from your earnings, but then it gets added back for cash flow. And when we do valuation, we do it based on cash flow, not earnings. The other thing too is you're going to have an apples and oranges comparison because people historically are looking at the historical multiples, and now you have like this new normal where you can't compare to the historical because now you have this massive ramp in CapEx. So if you're looking at the previous multiples and applying them to today's metrics, you're getting like an apples and oranges comparison. So you're having a fundamental shift in an industry. This doesn't happen that often. So that's the type of stuff that is interesting, being able to adapt to it. Burry also started a Substack that now makes $300,000. Wow. Interesting. That's pretty crazy. $300,000. Not bad. I mean, also like investing is a whole other ball of wax. And then you got people that could pull their funds and all that stuff. So there's a lot that goes on with it. Thoughts on JP Morgan versus MicroStrategy. So MicroStrategy like rises and falls with Bitcoin. It's like a 1-to-1 correlation with Bitcoin. So I personally, honestly, I would rather own Bitcoin than MicroStrategy. What's really interesting is MicroStrategy has, Wall Street Giants dump MicroStrategy shares. That just doesn't make sense to me. Why would you dump the shares when it's at a low and Bitcoin's down? But they also have like window dressing and all that stuff. Okay, so JP Morgan accused of manufacturing October 10th crash using 42-day-old document, of orchestrating October 10th crypto crash by recycling 42-day-old MSCI document warning of MicroStrategy delisting risks. Oh boy. JP Morgan faces boycott calls after MicroStrategy stock crash. I'm going to give like a hot take. So what I actually think is very interesting is MicroStrategy has two preferreds. So let's see. ST. Let's see. MicroStrat. There we go. So there's STR. Yeah. Okay. So there's STRK, which has a 10.46% yield. Okay. STRK. And then the other one was STRF, which has a 10.22% yield. I think that is actually way more interesting of a play if you want kind of like a hedge. So you want exposure to MicroStrategy. You don't want to deal with the volatility. And you also want to get a return, like a coupon that you can clip. That's the one that's really interesting to me. So I'll pop it up on the screen. There's STRK and STRF. So they literally sold preferred stock so that they could buy Bitcoin. So STRK. Bam. Let me share the screen. Yes, there's STRK, STRF. There's a few other ones, but these are the more recent ones that have much higher yields. Of course, I say something and now it's up after hours. I don't have that power. So forward dividend and yield. Yeah, there you go. 8. You see right here? Meow, meow. 8, 10.46%. So I think that's a more compelling play. And if you look, it also ripped. So again, preferred stock should not trade like a regular common stock. It's debt. So when you look at it, if you have 8, let's see. So the high 126.95. So 8 divided by 126.95. So that's 6.3% yield. All right, 6.3% yield. Not really that interested. But 8 over 78, that's a 10.3% yield. That is way more compelling. This is like what I would play as like a nice hedge to everything, because you're going to get the benefit of the uptick in price. So, I mean, think about it. Let's say you bought this in the springtime at like 80, and then boom, it goes up to 126. So you ended up making more than a 50% return on the underlying. In addition, you're getting that 8% coupon, that $8 coupon. So that to me is really, really fascinating. That's what I think is a really interesting play. So there's STRK, and then the other one is STRF. So I don't know how much they raised with both of these, but it was literally just to buy Bitcoin. They sold this to buy Bitcoin, period, full stop. So this one doesn't have as much of a price pop, which is interesting. So this has a $10 coupon, so 10.22% yield. I like the STRK a little bit better, to be quite honest with you. But that's what I think is interesting there. But I mean, in terms of the whole JP Morgan thing, I don't know if that's like conspiracy theories or what's going on there. I didn't really honestly like read into it or anything until you guys mentioned it. Honestly, I didn't even read about it. But that's interesting. I mean, good luck trying to take on JP Morgan. But do I think JP Morgan did some nefarious thing? No, they got bigger fish to fry. Yeah, you mentioned you need to follow viewership when I brought up SAP last week. Yeah, I mean, and honestly, SAP is very interesting. When you mentioned that, I started looking at it. I was like, dang, this would be a really good one. And that's just the unfortunate reality. Now, eventually, when like we have 100,000 subscribers, I'm literally just going to do videos that I want to do. I could care less about what, the idiots on YouTube do. Because you got to remember, like these other creators, they have no finance background, no Wall Street experience. It's like, it's bizarre to me that you're just going to like listen to random people that have no credibility. I just don't understand that. I remember one time I was like, when I started out, I found one of these clowns and they were like, I started investing in 2017. This is my channel that talks about investing. I was like, okay, that's great. Like that to me is just like bizarre. That's like a hobby. Like, okay, like why would I listen to you about investing? It's just like wacky to me. I don't get that. Oh, here's an interesting one. Baba earnings tomorrow. Will be interesting to see how it plays out. Yeah, it's a good point. That's one that freaking ripped after we covered it. Let's see. Where's Baba at now? Baba. Holy Moses. Yeah, Baba, damn, 161. Yeah, that's gone bananas. Yeah, when we covered it, it was so funny because I remember when I did the video, people are like, "Oh, it's garbage, da da da," and then it just like absolutely like had this like face ripping return there. So that one, yeah, that one will be interesting to see. Um, I think a convertible arbitrage play on MicroStrategy is the way to go. I'm not sure how to execute it, but I am confident in saying MicroStrategy will remain volatile. It will remain volatile. I mean, you know, the real play is to go long that preferred, the STRK. I like the STRK more than the STRF. Um, but you know, just play that, and you're not going to have as much volatility as you do with the underlying stock. And you also have, you know, the coupon. You have a 10% yield. So imagine like you buy in, your price that you buy in is going to give you a 10% yield. And then when Bitcoin comes, you know, back online and like the stock starts going up. Remember, MicroStrategy announced that they bought like so many Bitcoins like over the past week at an average price of like 90 something thousand. So they're going like hard into it. So once it goes the other way, then you know the stock's going to rip, the preferred's going to rip. So if you want exposure to a MicroStrategy but without the volatility of the underlying stock, that would be the play. Honestly, would be the STRK. But you know, and also like I would rather have that than either straight up Bitcoin or the MicroStrategy stock. So like MicroStrategy, I mean, geez, 52-week high 457. Today it closed at 179. Yikes. But there's no yield. There's no dividend. You get no return on that. Whereas the preferred, you get a 10%, 10.4% yield. I mean, that's phenomenal. Volatility's coming down. U.S. stock futures are a little changed after tech rally boosts stocks. Okay. I always love these like random articles that I see. Dr. Phil was America's best known celebrity therapist. How did his media network crash? Ooh, there's a conspiracy. Uh, Historic Thanksgiving travel surge collides with coast to coast storm. Ooh, oh boy. And then the next article is actually pretty interesting. The S&P 493, meaning excluding the Mag 7, reveals a very different economy. That was funny because like I was running the JP Morgan program over the summer, and if you take like the S&P and you exclude the Mag 7, it's like down. So that's what they're referring to there. Yeah, Baba will be interesting. That will be interesting. Yeah, I wouldn't touch the stock with 100-foot pole. MicroStrategy is just bonkers. That's one like when the volatility starts to hit, you're not even going to open your brokerage account. Like you just don't even look at it because you can't face it. But the STRK is a good way to get exposure to it. So you're getting exposure to Bitcoin, you're getting exposure to MicroStrategy, and you're getting a 10% yield. Like that to me, I think is kind of a no-brainer. And I've looked at it previously. Of course, the last time I looked at it, I was like, "Oh, this is great." And then when I like went to go buy it, it just like went like parabolic. I was like, "Oh, there it goes." But now it's actually at a decent level. I mean, if you could just get like a 10% return and also have the upside potential, it's like that's kind of pretty awesome. Hey Ken, do you have any energy plays? How are you thinking about energy? So, I was speaking to a buddy of mine who runs a $2 billion family office. And we were talking about AI, energy, the whole nine yards. So here is the play. The play is LNG, liquefied natural gas. So I think we all are aware of the fact we don't have the current infrastructure that we need to support all of these data centers. The data centers are here, they're coming, like that's not a question. The question is, what are they going to do? Now, for those of you who have any familiarity at all whatsoever with like energy infrastructure, it's like very slow moving. So the idea that we're going to make significant monumental changes to the electrical grid to support all these new data centers is like not going to happen. Very heavily regulated, very slow moving, like not going to happen. So obviously it begs the question, well, how are they going to power these data centers? Well, it's like, what do we have that's online right now, is quite abundant, relatively cheap. It's like, what are we going to do? I mean, literally natural gas. They're going to freaking pump natural gas. They're going to use that, power generators. That's how they're going to get the energy to begin with. Eventually, yes, nuclear, all that stuff. But if you actually do the research, a nuclear reactor, even these like small nuclear reactors, they take like 10 to 20 years to build. Okay. I mean, it's just like a freaking Herculean effort and process. And you got to remember, like, they haven't been coming online in any meaningful way for like decades. So this is like a technology, like it exists and all of that. But, you know, if you're like, hey, I want to build a nuclear reactor, it's like, good luck. Like, you're not going to be able to. So the time frame that is going to be needed for all of that, it's just way longer than the data centers are going to have. So that would be my take. LNG. And that's where I would be doing the research, because that's going to have the biggest impact over the short term as it pertains to data centers. No question in my mind. No question in my mind. So Bartush said, I like EXE for energy. Let's go check out EXE while we're at it. EXE. Expand Energy Corp. All right. Ugh, all these stupid pop-ups. Meh. Okay, here we go. EXE. So this is Finviz, which I like for a free resource. It's phenomenal. So let's see, 116.55. All right, so it's kind of ripped recently. What is the target? 132.57. Let's see what the research says here. Oh. Wow, nobody's really covered it in a while. Blair has it at outperform. Roth has a downgrade. Rutro, a lot of upgrades in the springtime. I'm not familiar personally with EXE. Let's see what Yahoo says. EXE, expand energy. All right, let's go share something else. Expand energy. All right, let's see. Profile. Bam. Oil and gas, yes. Operates as an independent natural gas production company in the United States. Company engages in acquisition, exploration, development. Okay, here we go. Holds interest in Marcellus Shale, Northern Appalachian Basin in Pennsylvania, Ohio, West Virginia, Haynesville, Bossier. So they are, I guess, a fracking company. Oh, it was Chesapeake. Oh, okay. Yeah, I know Chesapeake. Interesting. The one thing that you have to make sure of and always be careful with is make sure that like it's just common stock. It's not set up as an LP, because there are tax implications to that. So you do have to be a little careful with that. Just giving you guys like a heads up there, because you can have massive tax, potential tax issues with that. Let's see. Price to sale, price to book. Okay, 7.4 times EBITDA. That's not too crazy. All right, operating margin, 29%. Profit margin. What about returns? Return on equity, low, 6.12. It's obviously ripped recently. Levered cash flow, 2.2 billion. So levered cash flow, 2.2 billion on a market cap of 27.4. Okay. So not a huge yield, but that's really where you guys got to do some homework, is check out LNG companies, liquefied natural gas. Those are the areas that are interesting. Hey, Ken, thank you for the value you bring and the credibility you have. You're welcome. Thank you. What's your take on SMCI? They were previously accused of some past accounting accusations that seemed to put downward pressure on the price. So, glad you asked. The actual business itself is interesting, right? Cooling racks for data centers, you know, the servers, etc. The bigger issue is exactly what you referred to, which is the accounting issues. That company, all right, I've never seen like a company with like the weirdness that they have. So for example, free cash flow. Free cash flow is the type of thing that should kind of like go up and to the right. With this company, literally positive, negative, positive, negative, positive, negative, positive, negative. Like it's positive one year, it's negative the next year. I've never seen anything like that my entire life. It's like straight up bizarre. Now, when you look at that, it's all with the working capital. So inventory, accounts receivable, accounts payable. So it leads you to believe there might be some shenanigans going on there. The other thing, they have two related entities that it's like super incestuous, like the brother-in-law and like the sister run the companies. They have these huge exposures to the companies. The companies have given loans to the CEO. It's just like, what is going on here? Now, if you look at Hindenburg research, I would encourage anybody that's interested in investing in SMCI, go look at the Hindenburg research expose. Now, the funny thing is Hindenburg research is no longer around because they were specifically focused on shorts. And shorts, it's a very, very, very difficult area because you need a catalyst. Now, I'm just going to share it real quick. All you have to do is type Hindenburg research SMCI. This is like FBI level analysis, like truly, okay? So the coverage that they have on this is insane. Insane. All right. Now, here's the interesting thing. They have spoken to salespeople that worked for the company, people that like were literally kicked out of the company. Improper revenue recognition, recognizing incomplete sales, circumvention of internal accounting controls. Now, the problem is, I remember on the channel, somebody commented, and I was like, check out the Hindenburg research thesis. And they were like, Hindenburg doesn't exist anymore. Now, again, that doesn't invalidate what they wrote, you dummy. I always love the people that are like so freaking sure of themselves. And they just like, oh, well, they're like Ernst & Young. Okay. Ernst & Young ended up saying, like, they literally sent a letter to the Securities and Exchange Commission. I've never seen anything like this in my life. They sent a letter to the SEC, said, we're no longer their accountant. We cannot explain what's going on there. Now, you could decide, yeah, we don't want to be your accountant anymore, but to send a letter to the SEC, bizarre. Bizarre. Also, they missed filing for 2 quarters last year. As a result, all of their debt came due. Now, if you work ever in a corporation, one of the things that I can tell you is like literally on a daily basis, everything's being accounted for. The fact that you can't produce your financials within 45 days of the end of the quarter, something makes no sense there. Something is very, very off. And they're like, oh yeah, sorry. It's like, sorry, like what? Why is there this delay? But I won't spend too much time here. You guys need to check this out. If you have any inkling of investing in Supermicro, look at this first, please. Okay. And these are the 2 companies, Abelcom and CompuWare. All right. Super sketch. All right. So I want you to just get a sense of things here, like how detailed this is. Wait for it. I know I'm going fast. So they have drone footage. They have a whole bunch of stuff. And they were previously delisted, by the way, in 2017. So there's a lot of stuff here, but I'll go quickly through. There's like, look at the detail here. Like, oh yeah, you might have heard of them. SEC. I mean, they do a deep dive, deep dive. They're grabbing like lawsuits, and they're looking at, the Abelcom CompuWare. That's where Supermicro is. Wait a second. How's that possible? Like, this is super, 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 super deep. Like, they went hardcore. All right. This is bananas, the level of depth here. So you can't just dismiss it. All right. You can't just dismiss it. But that is what I would advise. So from the jump, like, I'm a fan of the business model. But anybody that's in the know, and there's a lot of people that have commented when I've done the super micro videos, they literally are like, I work in the business, and Hewlett Packard Enterprise like literally does the exact same thing. And it's like, oh, so there's no competitive advantage. It's like, nope. And that's the thing. And they even say, the company says itself, like, their business is like Legos, like they put Legos together. Obviously there's some level of technology there because they got this liquid cooling for the servers, but I would be very, 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 very careful. Very careful. I would definitely check out the short report. What's your take on FICO? It's been swinging so much of late. So Fair Isaac is an interesting company. The business model is very much like a Moody's, which is a Warren Buffett investment. I haven't looked at it in any detail, but I will take a look in real time. FICO. I haven't looked like dug deep into FICO in a while, but it's definitely an interesting business model. Okay, interesting. 1748.25. I guess they don't like splitting. Fair Isaac. Here we go. Bam. Let's see here. Okay, 1748.25. Target price 1975.42. Okay, it's not at like a massive discount. Uh-oh. Downgrade from Oppenheimer from outperform to perform. And then these guys have a buy 1800. These guys have a buy 1600. Looks like they blew through both of those. Let's see. Hold on. If you go down further, you see how they do on the quarters. Wait for it. Wait for it. Not that. Oh, insider trading. Oh boy, watch out. Sales. Uh-oh. Sale. See, that I don't like so much. Why are you selling the stock, man? President and CEO. Bunch of sales. Pretty recently, too. And also at lower prices than the current price. So when the CEO is selling below what the current price is, that's where you're like, what's going on here, dude? Now, sometimes you do have to be aware, like, they get an option issuance and then they just sell it. So that's what's happening with the first one. And one of the latter ones. I'd have to look into that. That one's like a little bit of a red flag right there. The CEO just likes selling tons and tons and tons and tons of shares. But let's see. What's the short interest? Short interest. Not that much. 4.5%. That's not a big short interest. Compare. I wonder who they compare them to. Oh, they're like, you compare. No, you tell us who to compare. Oh, they're trying to upsell us. Good luck. Oh God, the pop-ups. Death. Let's see. Let's see if any of these metrics jump out at us here. Return on invested capital, that's nice, 69.84%. Very high margins. I mean, the profit margin, 33%. I just think right now, based on the limited analysis that I've done right here, it looks like it's not at a huge discount. That's my only unfortunate qualm with our pal Fair Isaac. Um, oh, here we go. Here we go. We've got an agreement on the natural gas. My buddy Garamay. Natural gas will power most of it. Yep. GE Siemens gas turbines have 2 to 3 year lead times. Everyone's focused on AI. None of it's possible without power. Yeah, I think that'll be a big area. Um, so to Garamay's point, the turbines, so like all of the infrastructure that's going to be needed to supply the power to these data centers is a whole other area as well. So all of these have to be considered. Oh, we already talked about SMCI. Late to the party. No, you're never late to the party. Do you have thoughts on Bitmine? So there's Bitmine. There's, who's the other one? American Bitcoin ABTC. That's another one. You're always going to have issues with like the Bitcoin miners, especially when it pulls back like this. What is it? ABTC is American Bitcoin Corp. And they're basically just mining and hodling. Um, it's tough. It really is because it's like I would just rather buy Bitcoin directly. Or we talked earlier about MicroStrategy, the preferred. The miners are a weird one. Unless you can get something where it's like an American Bitcoin, they basically have like solar panels powering everything, and like there has to be some sort of like how are you countering the whole massive energy expenditure that's related to trying to get these coins mined. But I would say I would just rather just own it directly. Just go for the gold. Just own it directly. Um, I guess this is EXE. I bought the company when it first merged, have an average of 80 and just sitting on it. I see the price of LNG increasing and being the top producer in the USA is beneficial with Trump wanting energy. Yeah, anybody that is energy that's going to be like literally supplying the data centers is huge. What are your thoughts on Duolingo and Shark Ninja? So I actually know one of the analysts that covers Shark Ninja. And he's like a real big fan of Shark Ninja. And if you notice, like, if you've been following the stock at all, they have like some real rock stars that they're getting on board in terms of like celebrities. So like I saw Tom Brady is associated with Shark Ninja, David Beckham. So it's like it. Everybody thinks of just like the Ninja blender and stuff like that, but there is a legitimate business model there. That's one that I looked at. It was just too expensive, so I was like, not gonna delve deeper into it. Duolingo is another one. That one is just like inexplicable. The valuation. Now I know it had experienced a bunch of volatility. So let's go see a stack chart. Let me share my screen. That was one that went completely bonkers. I actually had one of my students in my financial modeling class. He had like a stock competition, and he said that it was a sell, and it was like when it was in the 400s because it was like during the springtime. So he had actually looked at it in like the 400-ish range, and he's like, it's a sell, and it went to like 500 something. But kudos to him. Learned from your boy Ken, fundamental analysis. It has totally crapped out. It's interesting because they have the 1 year target estimate 271. The PE ratio is coming back down to earth. Again, this one, like this is one where we talk about like the art and the science of financial modeling. This was like a huge momentum play because it just ripped like as it just kept going higher and higher and higher, 400, 450, 500. It's just like, what is going on here? Now, this is where I like to just use like brute hardcore logic. All right. So the app is to learn a language, right? Now, you think to yourself, like, how often are you going to attempt to learn a language? Um, when you go travel, perhaps, but there's like an upper limit, right? So it's like maybe like one language, two language, three languages. The idea that you're gonna like stay with Duolingo, like ad infinitum. I just don't see it. Now I know, like, because my student who had looked at it had mentioned like there's like an AI component to it, and it's like it's just hysterical to me. Like anything you put AI, like dog poop AI, it's like, oh, whoa, we got to check this out. It's like, no, it's dog poop. They just added AI to it. Like there's nothing to look at. There's nothing special about it. So Duolingo, I just couldn't understand just from a logic perspective. It's like I've used, language learning programs, and I like buy it for a month and then like I cancel it. And I think it would be the same thing with a Duolingo as well. So that one I couldn't really like wrap my head around, but it might be oversold now relative to where it was. But when it was like $400 or $500, it was definitely super overvalued. Yes, I still am holding HHH, and I don't plan on selling, probably ever. That's the vehicle that Bill Ackman's going to use to create his version of Berkshire Hathaway. So I think that is definitely a total no-brainer. I know when I first started talking about it, it was like it was in like the high 60s, and now it's in like the mid 80s. But remember, Bill Ackman bought, I think it was, he bought $900 million worth of the stock, and he paid 100 a share for it. So just use brute logic math. He's like a Buffett type guy, so he's buying a dollar for 50 cents. So if he's paying 100 for it, he thinks it's worth at least 150. So I'm like, wait a second. If he thinks it's worth 150 and I could buy it at 60 something, this is like a total no-brainer. This is 100% return and then some. So I was like, done. 150% return, basically. So that's why I was like, buy it full position, boom. And it has fortunately gone up. The issue with an HHH, kind of like a Joby, you do a DCF, you're not going to get what you want to see there. Like, so you have to come up with a different logic than like, oh, I built a DCF model and that's why I bought the company. Not the case with that. But yes, I'm still holding that. And that's the vehicle that he's going to create his version of Berkshire Hathaway. And they're going to start acquiring companies. And, there's a lot of interesting stuff there. Lot of interesting stuff there. So that's one that like I think there's like 3 analysts that cover it. But it's a real estate development company, so you're not gonna the numbers that you see are not going to give you like any logic in terms of the valuation. Just think of it as this is an acquisition vehicle that is going to be utilized by Bill Ackman to create his version of Berkshire Hathaway. That was my thesis, and I was like, all right, that makes sense. I'll do that. Dun, dun, dun. Views on WTI stuck below 60. I was looking into oil, saw VNOM, just an amazing royalty business. They have debt due, but they're selling some properties to pay off the debt. I'm always leery when there's like a debt issue and they're selling assets to pay debt. So $60 a barrel oil. What I can tell you, and this has been the case for a pretty long time, that any like oil and gas explorers, like drillers, their break even from a cost perspective is usually in like the mid to high 50s. So basically what happens is when oil is like rising well above that, they'll just drill and they won't stop. When it falls below, like at 60, it's too thin of a margin. They're just not going to drill. They're literally just going to say, hey, we're not drilling. Like it doesn't make sense for us. It's not beneficial. It's not cost effective. So it's a weird thing. The other thing too, and this is where you got to factor in like geopolitical stuff. There's a lot going on right now as it pertains to like Russia, Ukraine. Is that going to end? What's going on with that? And you have to understand there's an obvious connection with oil in that whole scenario there. So I know that's very like vague, but at the end of the day, that's where I'm always like a little bit concerned when it comes to oil. So there's a lot more than meets the eye there. That's why I'm like a little like hesitant to get exposure to that. LNG, go bananas. Like that's definitely going to be needed for the data centers to power everything. But just be very careful when you're looking at like drillers and like fully integrated oil and gas, because the oil piece is a big problem when it's kind of like stuck, which is what it has been. I've applied digital plus return. CleanSpark seems to be another Bitcoin mining company to get in the data center space, has a great PE ratio. I'm curious if they'll get major contracts like Applied Digital. That's the tough part. It's like our boy Jeff isn't with us tonight, but Nebius, they had this announcement with Nvidia, and the stock just went like batshit, just went like totally parabolic. But it's like, okay, what's it actually going to mean for like future cash flows? And it's like, I don't know. That's where you always have these issues. So when you're dependent on contracts and they're not in place, that's where I'm always like, ooh, got to be careful. Ackman wants to IPO Pershing Square next year. I'm not really like that fascinated with that, because it's just an asset management firm. You could buy Apollo, you could buy Blackstone. Those businesses are not like really that fascinating. I would say you want to buy them when, they're down for sure. I mean, duh. But in a decreasing interest rate environment, you have LBO firms. I'm specifically talking about Apollo and Blackstone here. You have LBO firms that are going to finance with lower cost debt. Like that's the time to buy them. But asset management firms in general, just not a huge fan of the business model. It's just, that 2% of assets under management, 20% on the upside. But I mean, like the whole idea of IPOing, it's like, okay, so you can access the capital markets to raise capital to invest. It's like, now you have to get a return that's higher than your cost of capital in order to generate value. But then that limits you because you want to have a longer term investment horizon. So you're kind of subject to a whole bunch of weird factors there. So that's not one that I'd be interested in. I'm more interested in HHH because that's an acquisition vehicle. That's very different than Pershing Square. Thought on pins. Yeah, this came up last week, but fundamentals seem good. User base increasing. Paul Singer still holding approximately 5%. Gives me some hope. Curious what you think. So I always like when there's, a big smart investor that has an exposure to something that I'm looking at. What I would be curious of is if you could back into what his buy-in price is. So it's the same thing with Constellation Brands. So Constellation Brands, we calculated 197.09. That is Berkshire Hathaway's approximate dollar cost average into Constellation Brands. So it's like, okay, it's probably, frankly, it's probably above 200. So then you say to yourself, okay, if I could buy it today at 130, Warren Buffett has it at 200. I'm able to get it for $70 less than he got it. If he owns it at 200, he definitely thinks it's probably worth like high twos, maybe 300. So now you're like, wait a sec, I'm getting this at a massive discount. I'm getting this at greater than a 50% discount. Therefore, it's like, okay, it makes sense. So I'd be curious in that case, like what is his exposure, Singer with Pinterest. But I haven't looked a ton at Pinterest, honestly. I'd rather own Meta. That's me. I'm getting Instagram, WhatsApp, Facebook. I'm getting, a whole bunch of things all in one. And I already have a big enough exposure. So that would kind of be like my, oh yeah. And then there's Threads too. So I wouldn't want an overexposure there. But also the business model, you have to really get like a hardcore understanding of the business model and how they make their money. That's the key. Sorry for joining late. Don't be sorry. I was wondering if you've been looking at Novo Nordisk news. Yes, I saw that today. Disaster. So that one is interesting. I saw it come across the wire with the news of the trial failures with the Alzheimer's. This is always the challenge that you have with this. And, I've always looked at it as like, what's going to be the longer term impacts of Ozempic and all of these GLP-1 mimetics? It's indiscriminate in terms of the weight. You don't just lose fat, you lose all kind of weight. You lose muscle weight, you lose fat, like you just lose weight. And muscle is not the kind of tissue that you want to lose. That is the most prized tissue that we all have in our bodies. So I think there's longer term impacts that we're going to see from these GLP-1s that can't be determined in 6 months, 12 months, 2 years. But I did see that. I didn't see what the net impact was to the stock. Down 5.6%, Novo Nordisk. But I mean, that's a stock that's been kicked in the teeth all year, down 57%. Dude, Alex, so you said you're sorry that you joined late. I was actually referring to you earlier. Someone asked about Duolingo. And I was like, dude, one of my students did an analysis of Duolingo in a stock competition and said it was overvalued at like whatever it was at the time. It was like 400, 450. Dude, it's 173 now. You were right. But at the time, it's like, and this is always the challenge, right? It goes 450, 500, 550, and it's like, what the hell's going on here? Now it's 173. Guess what? You were right. Haha. So since I saw that you joined, I wanted to mention that because you were the one that I was referring to earlier. Duh. What do you think the fair value of Robinhood is now? That's a good question. That's another one that's just been like bananas from a risk and volatility perspective. Holy Moses. I mean, it has pulled back, which is nice. I mean, I thought it's been overvalued for a pretty long period of time. This one's interesting. This one I'd have to dig a little bit deeper into. But that's just been on an absolute tear. That's just like absolutely like gone freaking bananas. So let's check out Hood. Love the ticker symbol. Hood, y'all. All right. Oh wow. It was up 7% today. Our pal Robinhood. All right, so hold on, let me share my screen here. Robinhood. Yeah, this is one that's just gone like bananas. Recent growth reports, stock volatility. Company reported 115% year-over-year increase in platform assets. Yet its stock remains 24.2% below its 52-week high. I mean, this is pulled back with everything else, but I mean, it's still at a pretty frothy valuation here. This was one that I went to go look at, and then it just went like crazy. I was like looking at it in this area. It was like below 100. I was like, oh, let me look at Robinhood, and then it just went. Phew. So I was like, okay, not looking at that. This is another one of those like meme kind of stocks. Let's look at some actual statistics here, so we see some multiples and stuff like that. So Robinhood, PE's been expanding a bit. It's come back down. I like it more in this 30 PE. I mean, crap. Look at this. So March 31st, it had a market cap of 36.82 billion. Okay. And it's pretty much like tripled in 6 months. That is insane. That makes no logical sense. Definitely interesting in this area. But even then, crap. I mean, freaking 30x EBITDA. Like that's pretty bananas here. And again, let's face it, friends. It's an online brokerage. Like that's the business. Nice ROE, 27.8. I'd be curious to see how much debt they have. Okay, their net cash. They got 19.4 billion of cash, 16.2 billion of debt. So their net cash by 3.2. Yeah, this one would be an interesting one to dig a little bit deeper in. They on the other screen they had the value as 150. I'll pull it up on Finviz. Hold on. I just want to pull it up on Finviz and see what they say. Because they have what everybody's been Analysts have been covering it at. Let's see. Hood, y'all, hood. Yeah, this thing's just been on an absolute tear. Target 154.52. Okay, so Yahoo had 150. Return on invested capital 25%. That's 10% above Buffett and what he's likes to see. Oh, all right. Citizens JMP went from 130 to 170. That's the most recent coverage there. I'd have to dig into it. It's definitely looking better at these price levels than it was previously. But I mean, the stock's tripled in 6 months. I mean, that's kind of like, what the hell's going on here, you know? Curious on your view of diversification. How do you approach weightings in your portfolio? Also, is the percentage weighting that you wouldn't cross for a specific stock? Really good question here. So I like to have a more concentrated portfolio. If you believe in an idea, you might as well like get the most out of it. So when I originally invested in Celsius and it was at 22, I knew it was like significantly undervalued. So I don't want to take a 1% position because then when it goes up, it's going to be like 1.2% of my portfolio. It's not really going to move the needle. I kind of like having 10 to 20 stocks as kind of like the max, like the 20. So with that logic, you know, I want to have like a full weight in terms of my portfolio would be 10%. What I consider kind of like a good starting position before deciding if I want to get bigger exposure is kind of like 5%. So that's really kind of how I look at it. I think if you have less than 5%, it's like, why even own it? It's not even worth owning at that point because if the stock goes up, I mean, just do the math, right? You take your overall portfolio, you have a 5% position. If the stock doubles, all right, now it's a 7.5% position. But if you had it at a higher weight, 10%, now the stock doubles, it's 20%. You're getting that much more of a benefit. So I like running a more concentrated portfolio. My whole take is if I'm not going to have a 5 or 10% stake in a company, then I don't even really want to own it. And the only reason I want to own it is because I think it's significantly undervalued. That's why I always talk about it in the videos. 20%. 20% is like the Wall Street minimum of a discount. If I could get it at 40%, 50%, even more. I was able to get Tesla. When I bought Tesla, I bought it at like 140. I think my average price 156. I had the value at double that. I had the value at 280 at the time. I'm like, this is stupid. This is 100% discount. So when you have instances like that, you go hard into it. You're like 10%, get a full position into it. So that's pretty much how I approach it. Like somebody on the channel was asking about Adobe and they're like, hey, you know, your weight on Adobe, it was like 2%, something like that. And they're like, is that because you just started building the position? Yeah, it's now a 5% weight. But what you'll notice is when you have a 5 or 10% weight, and then it actually does increase in value, it becomes like 15 to 20% of your portfolio. That's where you have to kind of, you know, adjust accordingly. I don't agree with just wholesale selling something. So unless you think that the thesis has changed, the fundamentals are deteriorating, that's the time to sell a stock. Like it's not the same business, it's not the same company. That's when you sell. So when I did Tesla a few weeks ago, you know, I said it's overvalued. You know, 461, it's overvalued. I had a value of 408. So I said, if you don't own it, don't buy it at these levels. But if you own it, I wouldn't just wholesale sell out of it. You could trim the position if you have like a high weight, like it's 15 to 20%. Yeah, sure, trim it right here. But you're running like a very risky perspective by just wholesale selling it. I'll give you a perfect example, Nvidia. So Nvidia was one that I had that was like one of these examples where it was like a 2 to 3% weight because I didn't buy enough when it was cheap. And long story short, it got above my bull value. My bull case was 156. So the bull case is the best case scenario. So I sold it. I don't own Nvidia right now. Now people, obviously, typical YouTube poster, you're stupid. It's like, oh, okay. No, it hit my bull case, and I'm like, this is overvalued. This doesn't make sense. Now it went above 200. Am I wrong? Am I stupid? No, I still think it's like way ahead of itself on fundamentals, on intrinsic value. And then there's also the law of large numbers. You have a $5 trillion market cap, like it's going to go to 6 trillion, 7 trillion, 10 trillion, like by the year end. Like it just, the math doesn't work. It just doesn't make sense. So that's where you have to be careful. So I wouldn't necessarily say I wouldn't cross. Like Buffett, he trimmed Apple. Apple was 50% of his portfolio, 50%. And the interesting thing is, by trimming it, he lost $900 million if he would have just kept the weight. The issue, though, is when you have that big of an exposure, your portfolio is Apple rather than like a whole bunch of good ideas. So I'd rather have, I'd say the simple way to think about it, 10 stocks at 10%, 20 stocks at 5%, somewhere in between. So I would say that kind of like 15 is a nice number. And then the whole idea is you add more capital to it and then you decide to allocate based on that. But also, when the market was going down the past couple of weeks, one of the things I mentioned in last week's live stream was a really good mentor of mine said, you know what, always have like 5% of your portfolio sitting in cash. Now, most people would say, oh, that's a cash drag, that's going to hurt performance. His whole take was, if something hits, like it pulls back, it might not last that long. You look at like Liberation Day, you know, that wasn't like weeks long. That was like a few days, and then everything kind of came back. That's when I bought Meta below 500. I bought Amazon at like 168. You know, that's when it's like, okay, thank God I had some cash here that I could actually allocate. So that's how I think about weights. I wouldn't say there's like a weight that you don't cross. What I would say is if something becomes a big weight, just add more cash to your portfolio so that you could kind of even it out. That's what I would say. Hopefully that's clear. Views about real estate with rates coming down, supply shortages. How would you take advantage of this scenario if you had to? So I'm trying to think if I mentioned this to you guys previously. Fundrise. So I have Fundrise. They advertise all the time. So I have some real estate in Fundrise. So you can invest in the equity, or you can invest. They also have preferred. So I'm invested in the preferred part of the capital stack with real estate. So it's like 14 to 16% returns that you get. So you're exposed to the underlying real estate and that appreciation, and you're also getting like a fixed income like return. So that's what I like there. Until rates come down enough for builders to build, that's really going to be the challenge. So real estate's a tricky one right now, but you know, it's a supply demand issue. So realistically, when more supply comes online, that should end up alleviating, you know, some of the issues we've had with price. That being said, I also, amongst the million other things that I do, I am a licensed real estate broker in the state of New Jersey, and I get all of this stuff from National Association of Realtors, blah, blah, blah. I got an interesting thing today. 50% of the real estate markets in the United States are down for the year. So that's something that's pretty interesting. I think there was definitely a bubble from COVID, but there wasn't the supply that came on to alleviate it. So real estate is one of those things that it's all market dependent. So I've actually seen data showing near major like cities and metropolitan areas, it's actually getting better from a real estate market perspective. And they're actually having issues down in like Florida where everybody was flocking to. So if I had to invest in real estate, I would always want to be in like multifamily apartments, those types of opportunities. But right now, from like a REIT perspective and a stock perspective, I don't see much value in that area. Brookfield Corporation, one of Bill Ackman's top holdings. Yeah, Brookfield is actually an interesting one. I know you brought it up in previous live streams. It's like, it's got a little bit of everything. It's like a Halloween grab bag of assets. It's definitely a very, very interesting one. Oh, cool. You came in right during the Duolingo discussion. All right, perfect. Yeah, you were the student I was referring to, by the way. Dun, dun, dun. What are your thoughts on SoFi after their latest earnings? I think SoFi is a little ahead of itself. They're growing. There's no doubt about that. It was a lot more compelling, in the teens. But now, I mean, geez, it's up 8.77% today. I mean, you got to remember, it's still a bank. Net. It's still a bank. It's an online bank. So when I look at SoFi, I compare that to Ally. So let's go look at Ally. I'm going to look at it on my phone. Ally's actually ripped. So Warren Buffett owns Ally. He doesn't own SoFi. So Ally is at a PE of 23.7. SoFi is at a PE of 49. It's the exact same business model in every way, shape, or form. Like, you can get loans. You could trade stocks. You could get high yield savings. Like, it's the same exact freaking business model. But for some reason, SoFi trades at this like ridiculous premium that I personally don't understand. I just don't. It just doesn't make sense to me. I haven't looked at it since the earnings. They are growing tremendously, but I always want to buy at a discount. And this is another one. Like, if I do a video on SoFi and I say SoFi is a hold, people want to like crucify me and like throw tomatoes at me through the screen. And it's just like, what am I going to do? Like, lie? So it's always the case that if I do a video and there's search traffic and it's undervalued, that's kind of like the perfect Venn diagram, the perfect overlap where it's like it's undervalued, it's a buy, and people are searching it. It's like, there we go. That's the ideal. What's your opinion on Celsius? Yes. Is there a chance it could bounce back higher after the next earnings report? Yeah, 100%. So the big thing with Celsius, just so everybody understands, and I mentioned this in the actual video itself, they had a one-time distributor termination fee of like $246 million. What does that mean? So Alani Nu is now in the Pepsi distribution network. So they had to say goodbye to all their existing distributors. The problem with that is you have contracts that you're breaking with your existing distributors. When you break those contracts, you now are subject to paying these distributors. There's massive penalties. So now two things here. One, yes, it hit the financials, but Pepsi's paying for it. So it's a wash. Like, if you look at the Celsius like PE ratio, because it's like robot world, it's like 300 something. So it's like, oh, it's overvalued. It's like, no, this is not a recurring cost. It's a one-off, one-time thing. What's happening with Celsius is as follows. When Celsius entered the Pepsi distribution network in 2022, it was a bleep show. Okay. So what happened was they got into the Pepsi distribution network. They had the same thing, the distributor termination fees. And then they came into the Pepsi distribution network. The thing that really hurt them, though, was Pepsi took a bunch of inventory and then said, oh, sorry, we took too much inventory. So they gave it back. All right. Not all of it, but a big bunch of it. And that caused the numbers to just be like really wonky. So what's happening now, I'm telling you, is investors are concerned because they're like, we've seen this story before. When Celsius entered the Pepsi distribution network, that's when the stock went from 99 to 22. So what's happening now is people are like, OMG, like, what's going on here? That's a problem. My point is Pepsi has, on an as converted basis, an 11.6% ownership in Celsius. Okay. That's like $1.3 billion that they have exposed to Celsius. Okay. Celsius' success is Pepsi's success. 100%. Now, Alani Nu has been growing at leaps and bounds without Pepsi, meaning they just have themselves, their own distributors, etc. Okay. Now, a bunch of you have mentioned on this exact live stream and the past live streams, like, I see a lot more Alani Nu around. Me too. I was in West Virginia, not a place where you think energy drink capital. And I saw Alani Nu in like the most random places in Morgantown, West Virginia. So I was like, okay, this is like legit. Like, the branding's there. Now, when you enter the Pepsi distribution network, that means Alani Nu is going to be on shelves that they aren't currently on. So when the stock pulled back, full disclosure, I bought it at 44. Now it's like, oh, you're stupid. It's like, no. I mean, my average cost prior to that was like 22. Now my average cost is 25. 100% believer in Celsius. Definitely overvalued. I think it was like, what do we have? Like 75, 76 bucks as the value. No question. So December 1st, what is that? A week from today, they are officially in the Pepsi distribution network. So you're going to see the impact of Alani Nu being in the Pepsi distribution network. Probably not this quarter because it's only going to be 1 month of results. More so the first quarter results. So I would say you'll probably see the bigger pop from Celsius after 1Q, but it should be fine after this next quarter as well. The big counter argument was Celsius organic growth declined. So it was up year over year. So if you look at 3Q25 relative to 3Q24, it was higher. It was 3Q25 versus 2Q25. Organic Celsius, like Celsius itself, was down, but Alani Nu was up. And then they also brought on board Rockstar North America. So in US and Canada, that only contributed like 12.5 million to the sales. So it wasn't much, but yes, full believer in Celsius. I bought more, paid double what I had originally paid for it. So yes, I am definitely a believer. All right, so we're going back to Pinterest, PINS. Paul Singer, 28 million shares valued at $900 million as of September 30th, 2025. Wow. Yeah, that should give you hope. When you have somebody that has hundreds of millions of dollars exposed to a company, us having a few grand, not a big deal. So it's all like money where your mouth is. So when people like crap all over Constellation Brands, I'm like, dude, Warren Buffett has like a $2.8 billion exposure. And it's like, you're worried about like the 1,500 bucks you have in the company. It's like, whoa, hello. So yeah, that's a very positive sign for Pinterest. So yeah, we looked at Robinhood earlier. So it's 114. The value that we saw on Finviz was 154. So 154 divided by 114. Yeah, so it looks like it. 114 divided by 151. Yeah, 24.5% discount if you believe that that valuation. It definitely had gotten ahead of itself. I mean, the stock has tripled in the last 6 months, just FYI. So I think there's other like better opportunities out there with like all the pullbacks that have occurred recently in tech. But it does appear to be a buy. And thank you for loving the channel. We appreciate you. We appreciate all of you. Would you take an exposure in builders when the rates come down, or be a bit early into it like Buffett with his current picks? So the problem with builders is it's a much longer lag than what I think you're looking for. So I would try to pick the right pockets because the builders are going to operate in different areas. So there's some builders that focus on like senior communities. There's some builders that focus on single family homes. There's other builders that focus on apartment buildings. So what I would do is I would say, okay, like what is the area that's going to have the biggest positive impact and where are they building? That's really my bigger concern is like, where are they building? Are they building where there's obviously like a demographic shift? So like right now, like prices are coming down in Florida. People are, selling, going to more metropolitan areas. So like right now we have different real estate markets. Like ironically, New Jersey is like a very strong real estate market. Despite the insanely high property taxes and all the other issues that we have in the state, so it's like, wait a sec, that's crazy. So I would rather be exposed to a builder in like the New York, New Jersey area than Florida. So those are the types of things that you want to key in on. But I mean, there's other things where you think about it like jobs, right? So, Boeing is building a new facility in South Carolina that's going to support 5,000 jobs. Is there enough real estate around there to support all of those new workers? Probably not. So, like, who's supplying the housing? Those are the types of things, those are the opportunities that you really want to look for. That's where you're going to get a really great bang for your buck when you find those specific types of dislocations where, you know, there's a massive need for housing and they're going to bring it online in a particular area, and all the other infrastructures there. So if someone were building in like New Jersey, I would want them to be by like the train line or like a bus stop. That way people can get to work from there, assuming that they're going to work in New York City as an example. So that is what I would say in that case. But this is really where you'd have to do the due diligence, I really think, with the real estate. You'd want to make sure, because like there's so many different areas of real estate, but with the builders, it's going to be a much longer lag. That's what you would have to dig into. In case if there are no other stocks, it'd be interesting to hear a quick impression of the Calm stock. I have a few shares at 110. Let's go take a look. I'm wondering if this is Calmain. Let's see. Calmain. It has pulled back, so it looks like you made a good choice there. But let's take a look. Let's see what they say. So the stock has definitely pulled back. It was at like 115 in September. Wow. So it's down pretty substantially in the last couple months. Target price 103. That's not really that exciting from a discount perspective. I like the margins, profit margin, almost 30%, return on invested capital, 47%. That's absolutely incredible. ROE, 55%. So really, really great returns there. Goldman has a 110 price target. Okay. BMO, oh, that's old. So yeah, let's go with this Goldman one. Neutral rating. Definitely looks like you have it. If you bought it recently, you definitely have it at a discount. Let's see. Let's call it 85 relative to 110. I don't think it's going to get you to 20%. Yeah, 22.7%. That's an interesting one. Yeah, these are the types of stocks that when you do get the opportunity to buy it at a discount, you have to take advantage, because it's very rare that they do come up as a discount. But I'm just trying to think. I'm going to look in another area here. Hang on. Let me share this. Come on. Here we go. I want to look at the statistics here and see what we have. Wow. Super low PE ratio. Wow. 3.3. That's absurd. EV to revenue less than 1. Very good. EV to EBITDA. Holy crap. 1.66. This is like a value investor's, dream. Really high returns. Nice EBITDA there. No debt, dude. Yeah, this one's really interesting. This, I think you made a good choice there, friend. This one's looking really, really solid, and nice pullback from where it was in August. So yeah, that's a good one. That's definitely a good one. Good job there. Really good choice. With Celsius, what is your current weightage, and are you currently buying or waiting for it to find a base? Well, I wish I would have waited for a base, because I would have bought it in the high 30s. I bought it at 44, but I'll give you my current weight. And remember, like, the whole thing is, like, everything's imploded in the portfolio with the tech pullback. But I'll tell you what my current weight is. Wait for it. Wow, nice day. Let's see, CELH. Let's see. Wow, so it's a 3.9% weight with the pullback. So I would say I'll probably get it back up to like a 5% weight. And also now it's like 39. So I would be buying more. I actually appreciate the the reminder to check the weight, because it's definitely, it should be at least a 5% weight. Oh, hello. I do not live in New Hope. That is a very nice area, though. I'm in the Bergen County area, the Beak, as I like to call it. So if you know, like Paramus, the malls, I'm not too far from there, that area. So I'm like 10 minutes from New York State and 10 minutes from New York City, as the crow flies, as they say. Again, late to the live stream. All good. We're always welcome here, friends. Any thoughts about Hess Midstream? Seems to be a good defensive stock, less volatile than Chevron. So I think this one came up previously. Let's see. We were talking about, so you do have to be careful with the LPs. I did mention this earlier because I was talking about LNG. Let's go share the screen, Hess Midstream. So LPs have tax issues. You do have to be careful with LPs, just as like a massive heads up there. So just be cognizant of that. So if we look right here, Hess Midstream, targets 37 relative to 32. So it's not a huge discount. It was significantly higher previously. It was at 42. So it's down a decent amount here. You just have to be careful with the LPs. So if you're owning it in a tax efficient account like a Roth, that's what I would advise. It looks like it got downgraded here. Goldman has neutral at 36. It just doesn't look like it's at a significant discount there. But I'm definitely a fan. Definitely a fan. Da-da. Picture in picture closed to maintain recording quality. Okay. Let's see what else. Hey Ken, how's it going? It's going great. We've had a really robust discussion thus far. My fantasy football team's in the toilet, but the live stream is going really well. Really well. Quick question. When you hear things like analyst expectations, analyst estimates, who are they referring to? Excellent question. So we're talking about Wall Street analysts that cover the stock. So analysts on Wall Street that work in equity research, they will pick up coverage of a stock and then they will follow that stock. So well-covered stocks will have 30 to 50 analysts covering it. Stocks that have like single digit level of coverage, like SoundHound has 8 analysts. That's very low coverage. So when people say analyst estimates, that's what they're referring to, kind of as like a broad stroke, all the analysts on Wall Street in equity research that cover the company, meaning every time the company reports, they'll update their model, they'll issue new research, and they'll issue typically a new valuation on the company. And the other thing that I would say is, for whatever reason, people like discount, oh, Wall Street, like, and it's just like, it's such a dumb mindset. Like, if the analyst is wrong, people aren't going to listen to them. So these are people that follow like day in, day out particular names that are in their coverage universe. So when they're talking about analysts, they're talking about, you know, equity research analysts at various investment banks, Goldman Sachs, Wells Fargo, Deutsche Bank, JP Morgan, that cover the stock. So when they say analyst estimates, that's what they're referring to. They're not referring to YouTube creators. So that's the thing to be aware of. And also, like, when you listen to people on YouTube, I mean, you know, I have like qualifications and credibility here. Like, it's like I do this for a living. Whereas other people, like, I don't know how they come up with valuations. Like, I don't know. Like, they don't do a DCF model. Like, I always love when people are like, I think it's worth blah. And I'm like, where'd that come from? Like, I could show you, like, here's a model, here's the assumptions, here's everything that went into it. But it's like, yeah, I think it's worth this. It's like, why? Based on what? But that's what they're referring to when they talk about equity research. Yeah, awesome. No, it's like, I obviously, I think it's pretty obvious to tell. Like, I enjoy this because it's a good discussion. I get a sense of like what you guys are thinking, so it gives me like a view into kind of like the YouTube viewer who's watching this stuff and what they're thinking about. I like to think that we have a channel of, you know, investors that are a little bit more sophisticated, people that like want to understand the value of things and don't just want someone to like be a cheerleader for a stock. That is something I will never be. Like, I have no incentive to like cheerlead a stock. Like, I don't like losing money. So that's why, like, if you look way back on the channel, I covered Palantir when it was in like the 30s. And I was like, I'd love to own it. It's just not cheap enough. Now it like 5x'd from there. I haven't covered it since. Why? Because you have these like rabid people that are like insane about Palantir. And if you say anything other than it's the greatest company in the history of mankind, like they will just like downvote everything and just like hate you. So it's like, I'm just not going to do a video on it. Just like Rocket Lab. I'm like, I still to this day cannot understand the business model, how they make money. Like, yes, I understand they launch, you know, satellites into the air, rockets, you know, on behalf of people. I get that. But it's like, I don't see how they're valued at the level that they are. But I did a video on Rocket Lab. Oh my gosh. It was like troll fest. It was insane. People are like, you don't know what you're talking about. And it's like, all right, enlighten me. How do you come up with the value? And they're like, oh, like, it's just like bizarre to me. Like, it's like pure emotion. It's like, give me numbers, give me logic, show me how you come up with value. Like, that's all. And I was like, oh, you're stupid. It's like, okay, like that's your argument. All right, got it. Done. What is Ken's stock investment philosophy for someone who has limited budget, say 10K, in terms of number of stocks hold and investment strategy, growth versus defensive versus balance? Excellent question, my friend. Now, I'm going to tell you something. You're not going to want to hear it. Okay? And this is for everybody, not just my friend that just asked the question. Every single one of you, myself included, should dollar cost average into the S&P 500 VOO, the Vanguard S&P 500 total return. Now, you're like, whoa, what's with all the stocks, bro? You should do that for your retirement, i.e., Roth IRA, 7 grand, and your 401k. Max that out. That's literally the benchmark. That's what every professional investor is judged on. And by the way, 98% of professional money managers underperform the S&P 500 over a 10-year time frame. Now, once you're above that level, you maxed out your IRA, 7 grand, you maxed out your 401k, 23,500 plus the employer match. You're like, yep, I did that. S&P 500 VOO, got it. Now what? That's when we talk about individual stocks. So that's what I do personally as well. I'm not telling you something that I don't do myself. So it's like, max out the IRA, 7 grand, max out the 401k, 23,500. Once you hit that, boom, now go into individual stocks. So at 10K, dead serious, and again, I know this is not what people want to hear, that is the best play. Period, full stop. End of story. So if you think about it, the return for the S&P 500 total return over 70 years, 70, on average, 10.4%. So if you take the rule of 72, 72 divided by the return, that's how long it takes to double. You're talking about 7 years, actually a little bit less. So now you're like, my money's going to double every 7 years. Yes. And you reinvest the dividends, and that is the play. Nobody wants to hear that. I do this all the time when I run training programs, and I'm like, hey, I've got you. You're 21 years old. This is what you should do. And if you do the math, you'll end up with $15 million when you retire at 65. But here's the problem. I will tell people this, and then they'll be like, what about options? And I'm like, what about options? They're like, well, what do you think about options? It's like, no, dollar cost average in the S&P 500. That's it. And it's like, well, what about the S&P 500 momentum ETF? It's like, no, don't do that. So that's the long and short. Like, literally, I run training programs for very, very, very large asset management firms. Like, imagine if they're not going to pick up the phone unless you have a net worth of $10 million. I'm telling you God's honest truth. They won't pick up the phone unless you have a net worth of $10 million. Now, what am I teaching those individuals? Core satellite. Core S&P 500 total return, VOO. Satellite, 5%, 10% individual stocks, individual ideas. So you're talking about like people that have $10 million net worth. That's what they're doing. Not individual stocks. Not. So at 10K, that is the advice. All right. Because here's the whole thing. You're going to get that 10.4% return. Now, if you want to go into other stuff after that, by all means. But you want to have the base covered. That's what you want to have covered. You want that base covered. So I would say for you, if you say like, hey, like 401k, blah, blah, blah. Okay. Just do the 7,000. All right. Do the 7,000 for VOO, dollar cost average S&P 500. And then beyond that, the $3,000, that's where we could talk about, Mag 7 and being opportunistic with the Mag 7. So that's really how I think about it. I like to buy stuff that is trading at a discount, that has a massive competitive advantage, and is going to compound over the long term. So I have the entire Mag 7 except for Apple and Nvidia. Apple is overvalued. Nvidia is overvalued. I don't dislike the companies, but that is that's where I'm at. Like right now, out of the entire Mag 7, I think Meta and Microsoft present the best options in terms of buying something at a discount that has massive upside potential. Massive upside potential. 100%. Yeah, you're very welcome, man. Appreciate it. I mean, thank you. Like without you guys, I'm just talking into the into the void. So I appreciate all you. I know you posted a video on Chipotle. Are there any other fast casual companies that intrigue you? Potentially Shake Shack, Sweet Green, or Kava? So Kava's one that's interesting. I had to try it myself because everybody was talking about how amazing it was. And I was kind of like, underwhelmed. The falafel, I like to consider myself a connoisseur of Mediterranean food, Greek in particular. And the falafel, very underwhelmed. It was like mushy. Not good. Not good. But I'm not going to buy or not buy the stock based on the falafel. Very popular. Still in a growth path. So Kava, definitely an interesting one. I think more so than Sweet Green, but Chipotle is definitely at a discount. Chipotle still has a lot of room to grow. That one I think interests me more than the other options out there, but Kava is interesting. I honestly haven't looked at Kava in some time because Kava was really ripping, so it was well ahead of itself. Well, it's down 59% year to date. That's another one that would be interesting to look at, but I would say on a relative basis, you're going to get a better bang for your buck with Chipotle. Chipotle is trading at a greater discount than Kava, but Kava would be the other one that I would want to take a look at. That one's pretty interesting. Can you let me know your thoughts on RZLV? Let's take a look. RZLV. Resolve. Resolve AI. Well, it's got AI in it. You know that I'm going to love it. It's going to be the best company ever. Let's see. Resolve. Screen share. Resolve. AI PLC. So this is probably a UK company, I presume. $3.20. It was all the way up to $8.40-ish. So it's down pretty significantly. It's down like 60%. So target price $10.58. Okay. Institutional ownership 24%. Okay. I'm a little leery that there's no margin listed. I'm wondering if this company has revenue. And my guess is no. 3 buy ratings. Okay, that's interesting. Let's see what it says on Yahoo. RZLV. I just have like a feeling like my spidey senses are telling me this is one of those ones that doesn't have like financials. And I'm always very like worried when I see stuff like that. Okay, so let's see. I guess this was like a recent IPO. Good God. Enterprise value to revenue 187. All right, I will tell you I'm not a fan. Operating margin minus 513%. Whoa, what? Yeah, okay, let's take a look at this, friends. Revenue 5.3 million. Okay. EBITDA minus 159.44 million. Yeah, that's going to go into the not good bucket. 5.3 million of revenue minus 159 million of EBITDA. That's a problem. Not really liking this company. Also, let's take a look at the balance sheet. 986 million or 9.86 million of cash, 35.55 million of debt. Stay away, man. Stay away, stay away. Stay away. Like, this is bonkers. The revenue is 5 million. The EBITDA is basically negative 160 million. That's like, imagine if you made like $5,000 a year and then like after your expenses, you were 160,000 in the hole. That's basically what's going on there. That's pretty scary. So stay away, please. As long as you like making money. Good tips on DCA, on VOO. Good foundation for everyone. Roger that. Don't be too greedy. Yeah, don't overcomplicate it, man. Like every 2 weeks that you get paid, you know, just if you take 7,000, you divide it by 26, assuming you got paid every 2 weeks, it's $269. So just boom, 269, 269, 269 into VOO. Just roll like that. And the big thing is market's down, buy it. Market's up, buy it. It's just you have to have the discipline and focus on the long term. Long term. That is absolutely critical. So critical. Can't stress that enough. So yeah, you just have to be disciplined with it. And again, this is your foundation. This is your base. So like you want to focus on that. It's not sexy. I'm not going to be able to have a YouTube channel that just says, hey, by the way, dollar cost average in the S&P 500. Thanks. See you next week. And just keep saying it over and over again. But it's crazy. Like people don't do it for whatever reason. It's just bizarre. And you're getting the Mag 7. You're getting all of that great stuff. I mean, 33% of the total value of the S&P 500 is the Mag 7. So you're getting exposure to the Mag 7 when you talk about like tech and growth and all of that stuff. You're getting it. You're getting it. Also, I read that BWXT secured a zero coupon convert at 260, 50% premium. Super interesting company, but cannot make sense on why investors would make that bet. That is not a good bet. I don't know if you were here earlier, but we actually talked about STRK and STRF, their preferreds with MicroStrategy. So MicroStrategy sold preferred stock to buy Bitcoin, but both of those are greater than 10% yield, and they have upside potential when the stock recovers, not as volatile as the stock. So those are ones that are like really, really interesting. If you're going to talk about like a fixed income instrument, that's what I would look at. Melly, that one came up previously. Why does that sound familiar? Maybe you raised it previously. Mercado Libre. Yeah. So this one, let me pull up the old profile here. Dun, dun, dun. Online commerce platform in Brazil, Mexico, Argentina, and internationally. It can be accessed through mobile app, website, financial technology solutions, financial services, e-commerce. So my issue with a Mercado Libre is when you think about brokerages and financial services, very different, like internationally versus the US, like different rules, different laws, different regulations. Just like not interested in that exposure personally. I mean, it's the same reason like I'm not super interested in like any online like bank stock. Like I know people love SoFi, but like the business model is like it's Ally. It's just focused on a younger demographic. Um, but you're always taking a risk when you start like venturing outside of the US, unless you have like an integrated, international company like an SAP, which was raised last week and then earlier tonight. That would be an example where you're like, okay, like I could buy into that. But remember, like financial services, banks, it's not like a high growth business. Basically, what they do is they borrow short and lend long. So they borrow deposits at like 0.5%. They lend at, 5, 6, 7%. So they just make a spread. So it's really not a sexy business, frankly. You need a ton of volume for it to make sense. And that's really just the thing. So I'm just like not super interested in financial services in general. Yeah, it's defensive, but that one in particular, where they mention those markets, you have to remember there's going to be a potential exposure to inflationary pressures. You're exposed to each one of those individual currencies. That's where I'm like, and it gets to be a little challenging. All right, guys, it's been 2 hours and 11 minutes of fun with all of you. And definitely appreciate all of you. Ooh, this is a good one. So do you still hold MasterCard in your portfolio? Yes. That is one that I honestly want to do a video on. That is one that I want to increase the weight of. It's definitely undervalued. It's another one that nobody on YouTube searching for MasterCard. So it's like, there's no point in me doing the video, but that's one that I'm definitely a huge fan of. Definitely a huge fan of. So MasterCard and Visa, it's a duopoly. Both of those I think are kind of no-brainers, but MasterCard's one that I've been looking a lot deeper into, but you just can't do a freaking video on it because nobody's searching for it. So at this size, we're just subject to that. I agree, dollar cost averaging approach, but isn't the S&P 500 practically an all-time high? According to our economic cycle, we are headed towards a recession. See, this is the problem. We overthink it. Dollar cost average doesn't matter. Does not matter. You can't time the market. If you miss the 8 best days of the S&P 500 over the last 20 years, okay, your overall returns would be 80% lower. When do the best days occur? Right after the worst days. You can't time the market. So you can't say, oh, we're heading for a recession. I have a buddy, okay, in 2014, he said, quote, I'm concerned that we have too much debt, government debt. I think that the market's overvalued. 2014. Okay. So he's like, I'm not investing. Okay. Go for it, bro. So he's missed out on a 6x return because he was like, I don't like, we have too much government debt, blah, 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 blah. Missed out on a 6x return. So you just have to be disciplined, dollar cost average. Don't think about economic cycles, time in the market, all of that stuff. Over the long term, it goes up and to the right. That's what you have to remember. All right, friends, on that note, I'm going to cut it here. Appreciate all of you. Don't forget to tell everybody and their mother about this channel. Be on the lookout. Friday, we will be dropping a new video. And also, for those of you who celebrate, have a happy, safe, and healthy Thanksgiving. A lot to be thankful for, especially on this channel. Take care, everybody.